In the spring of 2024, a woman named Sarah opened what she thought was the best high-yield savings account on the market. The rate looked great, 5.2% APY. She moved $40,000 in and felt good about it. 12 months later, she'd earned about $800 less than her coworker, who opened a different account the same week. Same deposit, same year. $800 gone, quietly, while she did nothing wrong. This video is for educational purposes only and is not financial advice. Here's what happened. And more importantly, here's the 4-question test that would have told Sarah, in about 5 minutes, exactly which account to open instead. The high-yield savings account market exploded after 2022. The Federal Reserve raised interest rates 11 times in about 18 months, and suddenly, accounts that used to pay 0.01% were advertising 5%. The ads were everywhere. But here's the thing nobody told you. Not every high-yield savings account works the same way. The rate you see on the homepage is almost never the full story. There are rate tiers, rate caps, promotional windows, minimum balance requirements, and fee structures that can quietly strip out a significant chunk of what you thought you were earning. And this is where most people make the mistake. They sort by APY on a comparison site, click the highest number, and open the account. Done. But that top-line rate is a marketing number. What you actually earn depends on 4 things. The comparison sites almost never show you side by side. The average American household keeps somewhere between $10,000 and $50,000 in liquid savings at any given time. At a 5% account versus a 4.3% account, that gap is roughly $300 to $800 a year. Silently. No drama. Just money that was supposed to be yours, staying with the bank. So the question isn't which account has the highest rate today. The question is which account will actually pay me the most, given how I specifically use it. That's what the 4-question test answers. And which of these mistakes has actually happened to you? Drop it below. Have you ever switched accounts and realized the rate you were getting wasn't what you expected? That answer helps everyone watching this. Question 1. Is the rate promotional or ongoing? This is the most important question, and most people never ask it. A promotional rate is a teaser. The bank offers it for 3 months, sometimes 6, to get your deposit in the door. After that window closes, the rate drops, sometimes dramatically. Some accounts have dropped from 5% down to 3.5% after the promotional period without sending a single notification. The way you find out is simple. You look for the phrase introductory APY in the account disclosures. If you see that phrase, the clock is ticking from the day you open it. An ongoing rate, sometimes called the standard APY or base APY, is what the account actually pays long-term, tied to the Fed funds rate environment rather than a marketing window. Sarah's account had a promotional rate. When it expired, she didn't notice for 2 months. That alone cost her about $140, and the bank was not legally required to alert her because the rate change had been disclosed in the original terms she agreed to. Question 2. Is there a balance tier that affects your actual rate? Some high-yield savings accounts pay the advertised rate only on balances up to a certain amount. Others pay it only on balances above a certain amount. And some have a tiered structure, where different portions of your balance earn different rates. Here's a real example of how this plays out. An account advertises 4.9% APY. But in the fine print, that rate applies only to the first $15,000. Anything above that earns 2.5%. If you deposit $40,000, you're earning a blended rate of roughly 3.3%, not 4.9%. The math matters. Before you open any account, find the balance tier table in the disclosures. It's usually 1 page in. Calculate your blended rate based on what you actually plan to deposit. That single step would have saved Sarah's coworker from making the same mistake in reverse, opening an account with a high rate on large balances when he only had $12,000 to deposit. Question 3. Are there fees that offset the yield? This one sounds obvious, but it's sneaky. Most high-yield savings accounts advertise no monthly fees. And technically, that's true. But there are other fees that quietly chip away. Excessive withdrawal fees, outgoing wire fees, paper statement fees, and in some cases, inactivity fees if the account goes dormant. The rule that governs savings account withdrawal limits used to be Federal Reserve Regulation D, which capped withdrawals at 6 per month. The Fed suspended that rule in 2020, and it has not been reinstated. But here's the catch. Many banks kept their own internal 6 transfer limit and still charge fees when you exceed it, even though the federal requirement is gone. So you check. Does this account charge for transfers above a certain number per month? If you're using your high-yield savings as a working account, moving money in and out frequently, a bank that charges $5 per excess transfer can wipe out a month of interest income on a $20,000 balance. The cleanest accounts right now for this profile are ones with no transfer limits and no monthly fees, period. SoFi, Marcus by Goldman Sachs, and Ally have all operated in this space, though rates change constantly, and you should always verify current terms before you open anything. Question 4. Is the account FDIC insured and through which institution? Every reputable high-yield savings account is FDIC insured. But nuance matters, especially now that some fintech apps are offering high-yield savings products that are not direct bank accounts. Here's the deal. When a fintech company offers you a high-yield savings rate, they're often doing it through a partner bank. Your deposit sits at the partner bank, and the FDIC coverage is there, but it's what's called pass-through insurance. The FDIC covers you up to $250,000 per depositor, per institution, but only if the fintech's records are current and accurate. After the Synapse financial collapse in 2024, which disrupted access to funds for hundreds of thousands of customers across multiple fintech platforms, regulators started paying closer attention to this model. The accounts were technically insured, but customers couldn't access their money for weeks while the partner bank situation got sorted out. So question 4 is, who is the actual FDIC-insured institution holding my deposit? And is it a direct bank account? Or is it passed through a fintech intermediary? If you can name the bank on your FDIC certificate, you're in a stronger position. If this changed how you think about high-yield savings, this channel exists for exactly this. One financial story per week for people who are still building, not people who already have it made. Subscribe if you want the next one. So here's what some people in this situation actually do. The first action is to run the 4-question test on your current account right now before you touch anything else. Pull up your account disclosures, which are usually in the legal or documents section of your account portal. Look for the word introductory near the APY disclosure, a balance tier table, a fee schedule, and the name of the FDIC-insured institution. That takes about 10 minutes, and it tells you whether you're already losing ground. The second action, if you find a better account, is to plan your transfer strategically. Here's something most people miss. When you move money to a new high-yield savings account, the new account promotional rate often starts from the day of first deposit. If you're moving a large sum, timing that transfer to the beginning of a calendar month maximizes the days in the first cycle that you're earning the promotional rate. Also, keep your old account open with a small balance for 60 to 90 days after the transfer. Some banks report account closures in a way that can briefly affect your check system's record, which is the banking equivalent of a credit report for deposit accounts. A short overlap period avoids any gap in your banking history. One more thing worth knowing, if your total liquid savings exceeds $250,000, or you expect it to, you need to think about FDIC coverage across multiple institutions. The FDIC limit is per depositor, per institution, per ownership category. Couples with joint accounts get coverage of up to $500,000 at a single bank, because joint accounts have a separate $250,000 coverage per co-owner. That's a real mechanism, codified in FDIC rules, and it matters if you're at that level. For most people building toward that level, the practical answer is 2 accounts at 2 separate FDIC-insured banks, each holding no more than $250,000 per individual. The FDIC's own tool for calculating this is called ED, the Electronic Deposit Insurance Estimator. It's free, it's on FDIC.gov, and it takes about 3 minutes to run your scenario. Sarah eventually ran the 4-question test. She moved her $40,000 to an account with an ongoing rate, no balance tier, and no transfer fees. In the 12 months after that, she earned what she expected to earn. No surprises. No quiet erosion. That's the whole game with high-yield savings. It's not about finding the flashiest number. It's about understanding exactly what you're actually getting and making sure the account fits how you actually use it. The 4 questions take 10 minutes. The difference can be $300 to $800 a year, every year, compounding quietly in your favor instead of theirs. What did the 4-question test reveal about your current account? Run it and drop what you found below, especially if the answer surprised you. And if you want to understand what happens after you've optimized your savings, the next piece of the puzzle is where to put money once you've hit your savings goal and need it working harder. That video is already on the channel.